Oh man, the stock market has a lot going on right now. We've got the S&P down 1%, the futures. We've got the Dow futures down 0.5%, and you've got Nasdaq down 1.7% in futures going into the open today. You've got the Treasury yield hitting the 10-year, hitting 1.54%. That's the highest yield we have seen in December, and we're seeing people rotate away from bonds and from high growth tech stocks. What's going on? Let's try to break this down. So you can see here, you can see S&P is down, Dow is down in the futures, Nasdaq is down in the futures, and if we flick on over, let's take a look at the Treasury yield. So sitting at 1.53 now is the highest level since June. Now we need to remember that yields move inversely to prices, okay? So if a yield is going up on a bond, that means the price of the bond is going down, which means there's less demand for those bonds, right? Less people are buying government bonds. And we need to understand, why is this? This is because we are fearful, investors are fearful of persistent inflation, okay? So we had Fed Chairman Jerome Powell speak in his latest update where he said that, he gave some hawkish tones that we're heading towards more persistent inflation and we are going to carry out our monetary policy of easing the number of treasuries being bought. Okay, so currently it's 120 billion treasuries bought each month, and he said tapering is around the corner and these bonds will start to be reduced going forward. Now, what does that mean? Well, if you're heading towards persistent inflation and investors are worried about inflation, that erodes the purchasing power of your bond. Okay, so if you have a bond and it promises a 1.5% coupon, so that means it's going to pay you 1.5% of the initial face value of that bond. But if inflation is persistent and going up and up and up, that 1.5% in real value is less to you, okay? So less people inclined to purchase bonds, okay? So very important that we understand that. So we also have Fed Chairman Jerome Powell going to share some prepared statements to the Senate Banking Committee this morning. So I think that's 10 a.m. American time. And he's going to warn that high inflation is persistent. So let me just read to you what he said exactly. So he says, inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors. And guys, that's what we know is going on. These supply chain issues are causing massive disruption. I mean, let's take a look at this. So you can see here, let's share with you this. Petrol supply, army put on standby to ease fuel crisis, right? This is happening in the UK. I'm in London right now. This is happening on the ground. There are massive queues for hours and hours on end waiting for fuel at the fuel pumps. Not because there's a shortage of petrol, because there's a shortage of drivers and logistical transport. And it's not just here in the UK. LA Port, backup grows to record 62 ships and supply chain crunch worsens, right? This is a crunch where everything on the logistical surface is really getting to a meltdown. All of this untapped demand, and as things reopen, people want more and more things. This is all coming to a climax, and this is what's leading to inflation, okay? So this is unprecedented, and this is not just a UK issue. It's not just an America issue. It's not just a China issue. This is a global issue, and the supply chain right now is broken. We've got stuck ships. We've not got enough truck drivers, not enough ways to transport things, and this is weighing on investor concerns around longer-term inflation. And the fact that Jerome Powell, who has always said this is going to be transitory, that was his favorite word, is starting to change his rhetoric to a more of a persistent inflation, that is getting markets a bit concerned. The markets have come to the realization, as we can see by the yield prices going up, they've come to the realization that the hawkish tonality of the Fed is for real. Okay, so they believe that, because of this, due to this persistent inflation, we will see tapering very soon, and they're confident of that. And that's shown by their bet on the US dollar 10-year going up, the Treasury yield. Okay, so that's really important. So why is tech falling? Yesterday, we had Microsoft down 1.7%, we had Amazon down 0.5%, we had Apple down 1%, and we had Google down as well. And now, as I've just shared with you, you've had all of these futures down as well. Okay, so the Nasdaq taking a massive hit in the futures, currently 1.7% down. So why are people rotating from high value stocks due to inflation? Well, what happens is when you have a high growth high value tech company, if inflation is deemed to be persistent, so inflation is going to be high for a while, that then ensues that you have hawkish tonalities from the Fed. Okay, so we saw from the latest update on the dot plot that the Fed, majority of Fed officials expect a rate increase in 2022. So investors are factoring in a rate increase back end of 2022. Now, what that means is inflation will erode, again, similar to bonds, will erode the potential future cash flows that you could expect from your high-tech stocks. Okay, so again, it's eroding the purchasing power that you would expect you generate from your high-tech stocks. The increase in rates also make it difficult for high-tech stocks, which majority are cash flowed through borrowing and debt. It makes it harder for them to raise capital, raise money for potential growth, for investment, for their ongoing growth that they've promised and that they valued for, and also for stock buybacks as well. So this is weighing on the investment community, and this is why you're seeing a lot of the stocks which were deemed high value, because as markets going up, things were getting a bit frothy, valuations were getting pushed forward. Now you're seeing those cool down, and even the FANG stocks are taking a hit right now, and people are rotating out of those as we speak, which is why we're seeing this. Now, to September so far, I think the S&P off the top of my head is about 1.8% down. So we've not been close to our 5 to 10% correction yet, but it won't take many bad days like we're seeing today on the futures before we get to a 5-10% correction. And could this inflation woes be the trigger, the catalyst that pushes us to that 5 to 10% correction? So one of the things you can notice is when you see a move like this, oftentimes it can just be a few big hedge funds that are quickly moving their portfolio ahead of the anticipated 5 to 10% correction. So when you're seeing the first 2%, sometimes it's in the know hedge funds who are moving. So we have to pay attention to this and understand what they're doing. Now, there were a few pockets of strength. Most notably was energy. We saw some energy companies such as Exxon remain buoyant yesterday and so far in pre-market, partly because WTI crude was over 76, Brent crude was over $80. And again, this is due to supply chain issues, right? The fact that it's getting harder to transport this makes the price go higher. And that's where that may be a smarter investment to kind of rotate into. I think the moral of the story here is we're seeing the market rotate away from these high-tech frothy stocks. And I think especially for people kind of on this community, in our kind of demographic and type of investor, we can oftentimes become very heavy loaded into our tech names, right? Our Palantirs, our Teslas. And I think now is a good time to start thinking of more economically sensible trades for a downturn where high growth is, people are rotating away from high growth. What are the type of stocks you're going to enter in? I think that's where we need to sit back and try to evaluate, do we have enough exposure and variety to different types of stocks and for this type of U-turn that we see in the market. Now, on top of this, what we have is we also have the unnecessary and unneeded political showdown in Washington between the Republicans and Democrats. So the Senate Republicans blocked a House bill which was passed on Monday that would have funded the government to run to December, and it would have suspended the debt ceiling to December 2022. So they've blocked that, and now Congress will have to approve funding by Friday. So this kind of, this is weighing on sentiment as well, even though I don't think this is the only reason we're seeing this rotation. Like I've just explained, we've seen the yields go up, we've seen tech go down. This means that the increasing persistent inflation fears are present. Investors fear that supply chain shortages are not just going to get better overnight. We made videos about this. We saw what the head of Ford and VW and these top companies are saying. This supply chain issue is not going to get better in a couple of months, like Jerome Powell wants us to believe. So I've priced inflation in going into 2022 and even early 2023. That's how bad I feel it is in terms of the supply chain shock that we've seen. It's going to take a long time to resolve. So Senate will need to pass that in order to give funding till Friday and avoid a government shutdown. And a government shutdown is just not needed right now. We're in such a fragile economic recovery, and for America, who's considered the world's reserve currency, for them to be playing chicken with the fear of defaulting, the risk is there that they could default, and it's never happened before, obviously, and I don't believe it's going to happen. But why play chicken with it in a market which is so volatile right now, that wants clarity, that wants direction, that wants certainty? we're not getting certainty from any direction, right? You turn to any direction you kind of look towards, you're not getting a clear picture. You look at the supply chain, they're saying, oh, it's not going to persist. You look at inflation, oh, it's not going to persist. Everything's going to get better. You look at the economic situation here, oh, no, the debt ceiling will be fine. We'll deal with it. We just need a clear kind of path towards how this economy can trade. That's what investors look for. Unfortunately, we never ever get that perfect calm, which is fine. We need to learn how to navigate through those, and that's what ultimately will help us become better investors. So there you go, guys. That's a summary of what's going on in the markets. If you've woken up and you've seen that the futures are down, you're waiting for the market to open, you've seen the yields tick up, and you're not quite sure what that means, hopefully this has helped you understand that a little bit more and understand what the relationship is between bonds, your high growth stocks, and inflation. If you like this type of video, please don't forget to hit the like button and subscribe. Comment below if you want to see any more kind of economic analysis or a deeper dive into any parts of investment. Feel free to comment below so I know what it is you guys are looking for, and I will see you in the next one.